This is Barry Knapp with Ironsides Macroeconomics. It's Sunday evening, March 1st at 4:30 Mountain Time. By the time you receive this video, you will have received our full note this week, the piece that is typically behind the paywall. We tend to do this once a quarter or so in hope that you'll find the notes really helpful to your investment process and will decide to become a full paid subscriber and support our work. The note this week was titled Not So Hot. It did not discuss Iran, though it was in the back of our minds on Friday because we had heard that we'd been taking some serious steps, but had obviously no idea that the Americans and Israelis were about to attack. We were probably as surprised as the Iranian leadership was. The note was really about a resetting of expectations that the economy was going to accelerate in 2026 or fairly early in 2026. Now that may very well happen. There's lots of reasons we detail in the note why you could expect a pickup in growth later in the year. And one of the signals may be the performance of non-tech or communication services related economically sensitive cyclical stocks over the last 3 months or so, including mid caps and small caps. But we have to say, through earnings season, those sectors' earnings were running at about half of what you would typically expect in the middle of the business cycle. And for the first quarter, those expectations got marked down from 10% to less than 5%. Now, were this the only part of the story? We might be willing to look past it. Typically, stock prices will move a good 6 months before earnings bottom in a recession, and these little mini cycles within a cycle, oftentimes stock prices, almost always, stock prices will move before earnings do. But we're not really seeing it in even the rate of change of earnings growth and revisions. And we've got this big other factor hanging over our head, which is in the chart that I have in the background right now, which is the Treasury market, which is bull flattening from 2s all the way out to 10s. The market is telling you that the economy is not accelerating, that it's actually decidedly weaker than expected. Now, our 2026 outlook was, our base case was that the demand for credit, for funding, the Gen AI related infrastructure and other demands on credit were going to push rates higher. Instead, it's pushing credit spreads wider, and things are showing some signs of cracking. Part of our expectation that growth will accelerate later in the year is the Fed easing. And we've got obviously a group of Fed officials that are either late because the Fed is always late. That's part of the risk management style, but part of it is just groupthink at the organization. And there's a whole other group that's just resisting because they don't want to shrink the Fed's footprint, something we've been writing about continuously in recent weeks. So that was the big first part of the note and the primary theme in the note. We then went on to talk about capital spending plans and how they aren't really broadening out. We used Fed surveys. We used S&P 500 CapEx. We compared the impact of the Tax Cuts and Jobs Act to the One Big Beautiful Bill Act. We previewed the employment report this week, which we went through how the typical big seasonally unadjusted decline we get in January has been smaller since the pandemic. So that's tended to mean less seasonal hiring, but less seasonal firing. And it's made employment reports in January quite strong 5 of the last 6 years. They typically, though, get negatively revised in February. That's why we called it payroll payback in that section of the note. And then they're pretty weak in February as well. If we get a weak enough report, that'll get the Fed back, in the cutting game or in cutting mode. But it's obviously a little bit of a mixed blessing. The market could very well be vulnerable to a growth scare related sell-off, just given how consensus that view was or is that growth is going to accelerate later this year. The note winds up with our discussion of productivity or technology, productivity, and employment, and we do not think it's different this time. We're not heading into a dystopian employment nightmare. We'd warn you to check the backgrounds of some of the people writing these things. These are people that have never had to have their research scrutinized by a supervisory analyst on the street. They've never had to document it. They're storytellers. And that was a really dumb story, in our opinion. We doubt it's different this time. That's our brand, is it's never different this time. So anyway, we then went on to talk about midterm corrections, midterm election year corrections. And the important takeaway from all this is 2022, 2018, 2014, 2010, 2006, the Fed was tightening, and every single one of those was the catalyst for every single one of those corrections. They're not tightening now. They should be easing, but they're not tightening. So we're not as bearish as we were a year ago. As tempting as it is to go to New York all bared up and be kind of provocative, we do think you should be cautious here, looking for a little bit deeper pullback to buy, but we're not bearish. Banks, on the other hand, are getting pretty close to a point where, even though we took some money off the table 2 weeks ago, we're tempted to put it back on the table in the banks right here and right now. Bearing that from Ironsides. Have a good week, everyone. Enjoy the note. And please consider becoming a paid subscriber. We'd love to have you on board. Thank you.